because the only way that you can get interest rates high enough to do anything to any market is to get a real yield. And if the official rate of inflation is 8.5% in the US, it means you need a 9% yield to get a 0.5% above inflation. And even the 8.5% is questionable if you look at the statistics from 1980. So, but it works in the short term. I mean, this big sell-off usually I read the news from a couple of feeds, and the big reason that gold fell off so sharply was interest rates are going to go higher. So, and it will. I mean, they'll milk that. They, meaning the mainstream financial press, will milk that meme as much as they can, but it's temporary. Long term, there's a small earthquake starting to rumble that will grow in intensity and power over time. And I think the banks are scared personally by needing to put out that silver's not going to do anything this year, and trying to convince people with their psychology that it's not a good place to be. You should be, you'd be better off somewhere else. That's anything but true.
We're up next on the table of Titans. I think we've got everybody just about ready. I'm going to bring them on one by one and introduce them, and then let's go ahead and get started. I'll bring on Stuart first. Stuart, you're coming live. Stuart, you're now live on the program. Thank you for joining us. You're the author of Rigged. Just introduce yourself real quick, and then we'll bring on the rest of the speakers.
Thanks, Robert. Thanks for the invitation. Well, I was a journalist for 30 years, and I've been invested in precious metals since 2005. But I ran across Gold Antitrust Action Committee about 10, 15 years ago, and found they had some very interesting research on the manipulation of the precious metals markets and suppression of the gold and silver prices. I dug into it a couple years ago and wrote a book called Rigged, Exposing the Largest Financial Fraud in History. And it's sold a few thousand copies. I'd like to sell a heck of a lot more and inform the general public about what's going on with our monetary system.
Okay, thank you very much, Stuart. We're going to bring on David Morgan next. David, you're live on the program. Thank you for joining us so much. Give us a little bit, just real quick, 1 minute about your background.
Oh, David Morgan, interested in the money and finance markets from the time I was a very young man, and continue to this day. Found out about how the fractional reserve banking system works. Realized from the hard money advocates that sound money was a principle that I basically made my life's work. So, and a shameless plug, I just happen to have it laying on my desk, and I should probably get a case from you at a cost or just above cost. I could start handing them out at some of the shows.
Thanks so much. It's an honor being with you here, King David.
All right, we're going to bring on Nick next. Welcome, Nick, to the program. You're live. This is Nick Barisheff of BMG Group. He was a recommendation to have on my program from David. Said he's one of the smartest guys in the gold market, and I agree with him. Nick, welcome to the program. Thank you for joining us.
Thank you for having me again. Good seeing you again, David, Stuart.
And just 30 seconds real quick on your background, Nick. Who are you and what do you do?
I'm the CEO of Bullion Management Group, and our company has 3 bullion mutual funds, and we also sell physical bullion to high net worth investors and family offices all over the world. So that's the gist of it. I started the company in 1998, and it's been a long, hard journey because the time I started, I didn't realize the market was rigged, as Stuart says. And it's only when you get into it, and now when you consider it, is that it's not only the U.S. that has a vested interest in suppressing the gold price, but also China and Russia do. I mean, they're in the accumulation phase and are buying gold, it seems, in their sovereign wealth funds that don't report anything to anybody. And it's when they get the amount of gold they have as a target, that's when they'll transfer the gold from the sovereign wealth fund to the central bank and make an announcement of how much gold they actually have.
Thank you, Nick, very much. And we'll get more into the gold market here in just a moment. I have one more person to introduce. Also from the Morgan Report, we have David Smith, who's joining us. David, how are you doing today?
Very good, Robert. Happy to be here. I'm senior analyst at the Morgan Report with David Morgan. Contribute monthly to Money Metals, an essay there for going on 8 years. I'm a believer in the fact that we are in the midst of the early, I should call it late early stages of what will become the biggest bull market in our lifetime, especially pronounced on gold and silver. And most of my investable net worth is in that venue. And David Morgan and I have written a book called Second Chance, How to Make and Keep Big Money from the Coming Gold and Silver Shockwave.
Awesome. Thank you, David. So this is actually a suggestion for the channel to get us all together a while back. And I thought it would be great just to do it in the conference. Because I think, and we are live streaming to YouTube and Twitter, by the way. So we do have people in multiple outlets watching this, not just at the conference. But I love having you guys here because in this group of people is probably decades and decades of understanding and analysis and research on the precious metals markets. And I would like to bring that experience to the audience. And I'm gonna start off with like a price question. We've had a pullback in gold the last couple of weeks. A lot of people get discouraged when that happens. To me, it's part of a long cycle. If you look at long asset investment cycles, they do take time to play out. I don't worry as much about 2 to 3 week price movements. But does anyone here think that the prices that we've seen does that worry anybody that gold and silver have pulled back the last few weeks?
No, well, I guess I can be the first to speak, but the fluctuations have been going on. But if you look at the period, you know, we did a analysis from 2000, and the average annual increase in gold bullion has been 10% a year since 2000. Silver has been 11%. So when people get frustrated with this, I say, well, you know, if you just held gold, you would be getting 10%. And when the manipulation stops, then that's a major bonus. But in the meantime, you're not losing anything from waiting.
Okay. Any opinion on that, David? The question I asked was, any concern over the recent pullback, in the gold price?
Other than psychology, not really. I mean, I read a couple of bank reports. I won't name the banks, but they're of the opinion that, you know, with interest rates going higher, it's going to kill the gold and silver markets, which is anything but true. Because the only way that you can get interest rates high enough to do anything to any market is to get a real yield. And if the official rate of inflation is 8.5% in the US, it means you need a 9% yield to get 0.5% above inflation. And even the 8.5% is questionable if you look at the statistics from 1980. So, but it works in the short term. I mean, this big sell-off usually I read the news from a couple of feeds, and the big reason that gold fell off so sharply was interest rates are going to go higher. So, and it will. I mean, they'll milk that. They, being the mainstream financial press, will milk that meme as much as they can, but it's temporary. Long term, there's a small earthquake starting to rumble that will grow in intensity and power over time. And I think the banks are scared personally by needing to put out that silver's not going to do anything this year, and trying to convince people with their psychology that it's not a good place to be. You should be, you'd be better off somewhere else. That's anything but truthful.
Yeah. So wanted to ask David Smith, what's your view on the recent price action in silver? Do you feel as though in gold and silver, do you feel it's indicative of the actual market, or is it just the derivatives games that get played on an everyday basis?
I think that's quite a bit of it. Derivatives are the paper silver. And if people were aware that, forever you could buy American Silver Eagles for $3 over, for the premium over spot. And now it's $10, $12, $13. So really, if you wanted to buy Silver Eagles today, you'd pay $35 an ounce. And so that's just one element. There are so many things that are driving us toward which I believe will be a historical breakout, and it'll be a one-time deal. It'll be, I would call it almost similar to the palladium experience, where we'll see 300, 400, 500% move upward. And at some point that'll spike probably even higher and then come back into a much higher sideways range that trades there indefinitely. And when that finally takes place, I don't think we'll ever see silver in the mid-20s again. It's incredible that it's the only metal that's trading for less than its 1980 nominal price. When you look at lowly, iron is up 1,100%, lead's up 300 or 400%, and here's silver, one of the most critical metals out there for us, and it's trading at less than half of where it was. So I'm a little frustrated like everybody else, but I'm not concerned, because every time it gets knocked down, it bounces up again, and it refuses to stay down where people on the other side want it to be.
I agree with you on that, David. And I wanted to bring in Stuart because he's gone over the research from 𝙂𝙃 and wrote a book, Rigged, about it. Stuart, what keeps the price down? We know silver should be valued more. That we think gold should be valued more. What keeps the price down? What did your research tell you? Oh, I think you're muted, Stuart. If you can come off of mute.
Yes, I was. I'm sorry about that. Yes, it's the perpetual trading of these paper contracts, these derivatives, that ultimately will probably blow up the whole system one day. But the way I see it, I'm not a day trader. I mean, I'm a buy and hold kind of guy. I look at acquiring and holding precious metals as a long-term investment. So I'm not really worried about the day-to-day fluctuations. I see the trend despite the rigging, despite the manipulation. And I think that's how you have to enter the market if you're going to get involved in precious metals.
I agree with you. And I think, a pullback is a good time to get in. Is it just the metals that we should be concerned? I'll throw this out to anybody who wants to answer. Should we just be in the metals? And are we giving up, by being in the metals, are we giving up returns somewhere else? Or will the returns that we're going to get in the metals make sense? I think it's one of the questions I get the most. Okay, in my metals, should I go more metals? Should I do something else? Should I do Bitcoin or go speculate over here on real estate? I think, Nick, you had an article on this, the 100% gold portfolio. Why would you ever want to go into 100% precious metals portfolio?
Well, the thing is, first of all, you should separate your portfolio for long-term wealth preservation and trading. So trading, if you have the time and the expertise, that's a small segment of the portfolio. But for long-term wealth preservation, you need to approach it differently. The problem is that when we're overdue for a major market crash. You've talked about it before in your presentations, Robert. And by every measure, we're grossly overvalued. In the stock market's the longest running bond bull market in history, and we're now into a real estate bubble as well. This has only been sustainable because the amount of money creation that's gone on, it had to go somewhere. But the thing is that when these markets reverse and we have a crash, then it's likely that gold will be the only thing left standing and recover. It may have a short-term decline in the first couple of days, but then it'll immediately recover. But unfortunately, everything else will decline no matter how good the investment is under normal conditions. If you take real estate investment trust, for example, so they can be generating good yield and being a solid investment, but when the broad market declines, REITs will decline by more than the broad market because they're thinly traded. So any sell-off exaggerates the decline. Same thing happens in mining stocks. So we've had in 2000 and 2008, the markets took a major correction. Mining stocks declined by more than the broad market at a time when gold went up.
Mm-hmm.
So to me, the thinking behind the 100% portfolio is being kind of from the old school when we're in very dangerous market conditions. You step aside, you take your money off the table. So yeah, you might give up a bit of upside, but then you're going to prevent 50 to 70% losses. Because once the losses start, it becomes very hard for investors to psychologically get out. And they end up, riding the thing to the bottom. So my thing is right now, sit it out in bullion, and then when the market's finished correcting, you'll have the opportunity of a lifetime to reallocate your portfolio in mining stocks, REITs, technology stocks, whatever it is you want. Because whatever it is, at that point, they'll be at major discounts.
Yeah, and I think that was the gist of my presentation earlier is it makes sense for me to stay heavy in the metals until we have a flip of the market and you can find bargains elsewhere. If you're in the general market right now, you're not finding a whole lot of bargains. There are bargains out there, but even if they are a bargain, sometimes you're going to sit in that for a long period of time until market dynamics change. We had a question from Jennifer earlier. I'm going to put it up on screen. She's asking, I'm interested in your opinion on the impact of rising costs and a turbulent supply chain on the precious metal sector. So I'll ask you, David, we've had a lot of uncertainty in the supply chain. We've had rising costs. How does that affect precious metals?
Well, any inflationary expectations, and I say the word expectations, should drive the metals. It certainly has through all of history. Is it different this time? I guess you could say it remains to be determined, but people go to this grocery store and they find that every time they go, it's higher cost. Then that psychology will get into them and they will start to buy in advance because they're expecting higher prices and their purchasing power to be decreased. So therefore they take the currency they have and spend it and take what they can at the time. It's all explained very eloquently by von Mises in The Crack Up Boom. And again, he goes to the word, I think he uses the word psychology. Once you get that idea that, no matter what happens in the future, I've got to buy it now because it's going to cost me more. So yes, it could have an effect. Will it? I think it's already having an effect throughout the food chain and that type of thing. Is it built over into the precious metals? I'd say gold is pretty much indicating it has. The flow rates in the gold are significant. And just going back to Nick, you guys are both going to think it's a setup because I had the rig book sitting on my desk. This is Nick's book. Thanks for sending it, Nick. I don't know if you can see it on the screen, but it shows you over the last 20 years how gold outperformed the S&P and outperformed the bond market. So I've actually used that a few times on my interviews and, of course, in my private work that gold's basically done its job. And going a step further, the question you asked Nick, if I could follow up, because he's the one that did it, but he paid for the 𝙂𝙊𝙇 study on what's the perfect portfolio theory, we'll call it. And I forget the exact number, Nick. I think it was 15.7% gold in all conditions, inflation, deflation, stagflation, whatever. So, and even Jeffrey Christian did a study on his own for CPM Group and looked at 1968 until I think 2021 or 2020. And actually in his study, it was a 25% weighting in gold. But you'll never hear that in Wall Street. It just will never happen. So that's my answer.
The amazing thing there is there's a portfolio simulator on the Gold Hub website, and which allows you to put your assumptions for all the asset classes and the time periods and so on, and it gives you the resulting performance, standard deviation, Sharpe Sortino ratio, and everything. And there basically is no argument. You add 10% to a 60-40 portfolio, and the returns are dramatically improved. If the portfolio is more like a permanent portfolio with equal amounts of stocks, bonds, gold, and REITs, then you get almost double the performance of a traditional 60-40. So the thing that always is amazing to me is that pension fund managers, the institutions, all have portfolio simulators, and they can determine the factual outcome of what gold does to a portfolio, but none of them do it.
I'd push back on a little bit, Nick, on that. I think at their really high level net worth people, they do it in a whisper manner, but they certainly don't do it for the public. And it's certainly a secret. And I'm only doing that from personal experience. In fact, I'll just go one step further. There was someone that just got to me in the last couple of days, and their fund manager, their professional, told them, "Oh, well, you're only worth a few $1 million. You don't need gold. It's only people like me that have, pushing toward the half billionaire class that needs gold. You peons don't need gold." It was basically the gist of it. So I'm not really pushing back hard on you, Nick. I just think that some of the smartest people probably have gold, but they just keep their mouths shut. But you're never.
On that point, I agree with you, David. I was talking about the difference in institutions like high net worth investment family offices. They understand the process and they're investors. Like, for instance, recently, because of the Trudeau's actions with the truckers, we've had numerous people open accounts because they no longer trust leaving any money in the banks. So that's where it registered. But if you talk to financial advisors, that's way above their levels, and from a compliance point of view, they're not allowed to do anything about it anyways. We've had there's probably at least a dozen advisors that were supporting our funds and the ownership of gold, and they have since been driven out of the business, some cases charged.
Yeah, I got a follow-up question based upon a question we had in the chat, and it's talking about risk in the precious metal sector. I'm going to ask it as Stuart, because there is, I think, a perception that the metals come with a lot of risk, that the stocks come with a lot of risk. And I think that's driven, as Stuart alluded to, by a lot of the mainstream financial media, the licensed brokers. I mean, we all have to do disclaimers on YouTube. I'm not a licensed broker, because the profession of finance has a stranglehold on who can talk about what and how they can talk about it, why they push their product. So to me, I see more risk in traditional financial investments. But from a risk perspective, where do you see the risk, Stuart? Do you see a lot of risk in precious metal? Do you see the risk in the broad market? Where do you see the risk?
Well, I don't see risk in insurance if you're buying the insurance for the right purpose. I've got a couple of analogies here. I was speaking with a financial consultant in a major trading house a number of years ago, and I had a large percentage of my portfolio in cash at that time. And he was convincing me to try to put my money into equities. And I said, "Well, what do you think about precious metals? What do you think about gold?" He said, "Well, I can't talk about that." He said, "I'd get fired if I recommended it to you." And I said, "Really?" I said, "Well, personally, what do you think the average investor should have, invested in gold and silver?" He said, "Oh, 1 or 2% at least." And I said, "Well, how much do you have invested in gold and silver?" He said, "None." And I said, "Well, that doesn't make sense." I said, if 1 to 2% of all financial assets were invested in precious metals, the prices would go through the roof. And he really didn't have a comeback for that. But I agree with you that the financial mainstream financial advisors are not recommending precious metals. And so that's a drawback. But what I always come back to is the central banks. The central banks hold, what, 33, 34,000 tons. The central banks know something. And, you know, over the last dozen years, dozens of central banks have either acquired more gold and are repatriated their gold from London, from New York, and from Paris. And that says more to me than anything, that the central banks are holding money, the backstop for the whole economy.
And I think, Stuart, to that point, I just did a video on France repatriating their gold. I think they started in 2013, got it. By 2016, we think, based upon their the little information we get from their statements, but they repatriated it from London, and they've opened the Paris gold trading desk now. They're doing like they used to do in Europe, and they're actually have revamped their depositories. They put software on top of it so they can actually do trading. So now we see the Shanghai being helped out by JP Morgan in commodities, in the precious metals. They're signing up new people to trade there. You've got Paris, you've got Texas. You know, the reason we did the bullion depository, according to our comptroller's office, was to compete with New York. So now all of a sudden you got multiple outlets for gold. Does this, I'm going to pose this question to David Smith. Does this mean that I posited that I think that the gold trade's about to go regional? Do you think that could ever happen? Or do you think that the COMEX and London markets have a stranglehold on gold price? Do you think that could ever change?
I definitely think it can change. And in support of what Stuart just said, a nuance to the, I think it was the BIS international settlements that had turned gold into a tier one good as cash in terms of central bank holdings. What I did not understand until fairly recently is that when they hold paper derivatives of gold, they are now required, and somebody can contradict me if I have the percentages wrong, but they're required to hold 70 or 80% of that as gold backing that paper derivatives, not just having the derivatives out there on their own like has been traditionally. So it's to their best interest to hold more physical gold when you have to have almost as much as if you're backing paper gold. And that's just one element. But I think there's so many things that are set to make this different than we've ever seen before. And we don't know what element will be that straw that breaks the camel's back. It may be something that is completely unrelated to the elements that we all know that could bring about a massive gold and silver price rise. It could jump lanes to a contagion that Jim Rickard talks about, something completely unrelated to gold and silver that bleeds out into that lane, and suddenly it is related. And so if you look at the last few years, for example, every time we had a knockdown, instead of people stopping buying gold and silver, they bought more. So when it goes up, they buy more. When it goes down, they buy more physical. And I think the next time, if we do get a market crash, I think the paper silver versus physical silver gap will be wider even than it was in 2008 because there's so much pressure that's going on right now to buy. So the mentality is changing, and that doesn't necessarily show in the charts, and it doesn't necessarily show in the fact that silver and gold keep getting knocked down. But the fact that they don't stay down, to me, is a tea leaf that we need to pay attention to.
Okay. Last question for you guys coming from Kevin. I'll put it up on screen. Is Exner's pyramid still a valid thesis? And have we started moving to the downside, specifically for David Morgan, but anybody can answer?
Absolutely. I mean, I think it was, you know, par excellence look from a visual as far as how the whole system is structured. I mean, a pyramid is the most stable structure on the planet, so that would imply an upside down pyramid is the least stable. And as the liquidity crisis unfolds further, which we're already seeing it, you will see a run to gold. And before you see a run to gold, you see a run to cash. And that's why I've said over and over that the US dollar will probably look very good until it doesn't. The only way to go from dollars to gold at the end is that there's mistrust in the dollar. And we touched on that at the first question you gave me, I believe. And that was, it's the psychology. It's when I think that dollar isn't going to buy me what I want 2 months from now, I'm going to buy something with it. And anybody that has savings of any type anywhere in the world will say, I need to do something. Those that are just barely making it paycheck to paycheck, they're going to buy extra food. For the people that have savings, they're going to not want to keep it in the bank for reasons like Nick outlined with Trudeau, but other reasons being, I don't know what it's going to be worth now, but if I buy metals, I am probably going to be in better shape. So I think the run to gold, as I said earlier, has started. It has not spilled over into silver yet, but the Silver Institute just put out the new silver survey for 2022. And the title of the press release that went along with the release of the silver survey was 2021 was a record demand for silver. The retail demand in silver was up 36% last year. And last year it was 200 million ounces in the retail market. So the demand is obviously there. And so then someone will ask me, well, where's, so what's the driver? The driver in 2020 was primarily the ETFs. And the ETF demand in 2021 was not nearly what it was in 2020. So there's part of the answer.
Nick, you have any comments on that one?
Well, I think there's two main events that could happen that will make both gold and silver go ballistic. On the one case, you've got the fact that the U.S. may lose its reserve currency status. The Chinese are in negotiations with Saudis
to trade oil and yuan, right?
To do that. So if that happens, that ends the reserve currency status of the US dollar. The second thing when it comes to silver is everybody is aware of the crisis that the shortage of chips is causing for a lot of manufacturing. But sooner or later, some of the high-tech CEOs and billionaires are going to realize that without silver, they don't make any iPhones, solar panels, or any other high-tech equipment. And they're simply going to go out and buy a few $1 billion of physical silver. Because the COMEX paper silver doesn't do you any good to make iPhones, for example. You need actual physical silver. And that's where you've got an anomaly, that you've got a very small amount in the finished product. So it's kind of price insensitive to iPhone, whether the price of silver is $25 or $250, as long as they can get it. If they can't get it, then they don't make any iPhones.
You know, Robert, I think that the kicking Russia out of SWIFT was done without much forethought in terms of the follow-on events. I think that is so profound, and also the kind of freezing of $600 billion in their external assets that were going to be used to pay contracts that have already been agreed upon by both parties. I think that has fractured the confidence of everybody from the person in the street to the highest CEO. And I would say that even today, we're still in shock about that, and we haven't thought about the implications for us personally and professionally. And this is going to play out in ways that are unintended, and they're not going to be to the good. So once that confidence is broken away, you don't get it back. And so this is bad news. And also going back to something that one of the other attendees stated about the mining stock risk. Mining stocks are now trading at a 35 low ratio to the S&P 500, and they're also trading at a 35 to 40 degree low ratio to senior miners. So when these things do turn, if you have a few of the best, use that Pareto principle. Ask yourself, what are the 20% of stocks that I can hold that might give me 80% of the return, and focus on those, and then take a couple flyers if you want. If you ask yourself that question, you could be wrong, but if you don't ask that question, you will be wrong. And then when this thing turns, I think the potential to make money for your correct choices will be greater than it has been in decades, because of that disconnect between the senior, junior, and between the S&P 500 mining stocks. So yes, they represent more risk, but at this point, if you're careful, they represent enormous potential in addition to the insurance policy that you have holding physical gold and silver.
Okay, thank you, David. I'm going to end up with you, Stuart. I think we're about out of time here. Any last thoughts you want to share with our viewers in terms of your research or what you're seeing in the market?
Well, there's some major shifts going on geopolitically around the world. All of us know that, and you know, I don't agree with what Putin is doing invading Ukraine any more than I supported the United States invading Iraq under false pretenses. But Vladimir Putin is shaking up some things, and it tells us that the future is going to change. I think. I hope we don't end up in a hot war, nuclear war, as is being threatened. I think these threats are more about destabilizing Russia or the United States, and you know, the whole monetary system right now, the whole global new world order, as our presidents have talked about, is being challenged, and the whole monetary world order is being challenged right now. And I don't know how exactly it's going to shake out, but I think it bodes well for precious metals because it is the financial backstop of the world. And as I mentioned earlier, the central banks hold it and are accumulating it.
Yeah, I agree with you. And with that, guys, I think we're going to wrap it up for the roundtable. Thank you, everybody, for joining. We had Nick Barisheff of BMG Group, David Morgan and David Smith of the Morgan Report. We also had Stuart Englert, who wrote the book Rigged. All of you have been on the program and will return, I'm sure. And to all of our guests today, thank you so much for joining the conference. This was for everybody to be able to ask questions and figure out what to do with their portfolio, how to address risk. I think we answered a lot of those questions today. Thank you, everybody, for joining. We appreciate it.
Good seeing
Thank you,
you.
Rob.
Thank you.